Thank you, Uncle Mickey. As always, very entertaining. We do appreciate it. And I too would like to pay my respects to the Ghana people and pay my respects to the elders past, present and emerging. Just before we get into the presentation for today, I thought there's a lot going on in our world, and I thought it'd be worth making a few remarks about the external environment that we're all experiencing right now, and particularly energy, which I think is at the very centre of global conversations, from boardrooms to dinner tables all around the globe at this point in time. Conversations about energy security, cost of living, supply chains and inflation, climate change, geopolitics, and rising economic and resource nationalism. They are conversations of fear that I never expected to see in my lifetime. In Australia, they are the consequence of more than a decade of energy policy failure that, quite frankly, I've been warning about for many years. They're also the consequence of domestic climate wars, much more than they are a consequence of Russia's invasion of Ukraine. Climate wars that have left us without a carbon price or the right market signals for energy and decarbonisation investment. The high oil and gas prices that we're seeing today were emerging before the war in Ukraine. You will find this hidden in none other than the latest IEA World Energy Outlook, and I quote, "The strains did not begin with Russia's invasion of Ukraine, but they have been sharply exacerbated by it." The high oil and gas prices are a consequence of undersupply and underinvestment. Renewables were added at record levels in 2021, and their contribution to the global energy mix has never been greater. Yet, 80% of the world's energy still comes from hydrocarbons, the same as it was 45 years ago. Even in 2050, the IEA STEPS, the stated energy policies scenario, has hydrocarbon providing 60% of the world's energy in 2050. And this explains why there is not one IEA or IPCC scenario, not one, that does not rely or not heavily rely on carbon capture and storage to decarbonise the energy system by 2050. Because if the world is serious about net zero, then it has to be serious about decarbonising existing energy sources as the market evolves over time for a new clean fuels market, such as hydrogen. And we cannot get there overnight because the costs are simply too high, and we're already seeing the pressure on households, industries and economies around the world, even at today's energy prices. Today, we estimate that green hydrogen costs around 8 to 10 times the cost of natural gas, and that's just the cost of supply. Then there is trillions of dollars of investment required for infrastructure to switch to hydrogen. The strength of Santos' strategy and our business outlook is our unique position and capabilities to continue to supply our domestic gas and LNG customers who want security and affordability of supply for at least the next 2 decades. Our infrastructure position and expertise in carbon capture and storage that will enable us to reduce our own emissions and those of others at low cost and large scale, creating a new cash-generative carbon services business. And our track record, technical expertise and customer base that positions us to transition to clean fuels as customers' demand and affordability evolves over time. But energy policy globally and in Australia is at a very dangerous tipping point. Producers in the Western world have slowed or stopped investing in new oil and gas, but customers have not stopped buying or consuming these products because they can't. The low emissions technologies, the clean energy infrastructure required to deliver them is simply not yet available. And government policies that seek to disrupt the energy system so as to hasten the transition to a low-carbon future are having exactly the opposite effect. Underinvestment in gas supply since 2015, combined with sanctions on Russian supply as a result of its invasion in Ukraine is sending gas prices to record highs. Global electricity markets are switching back to coal, sending global greenhouse gas emissions to yet another all-time record high in 2021, and coal consumption to a record high in 2022. Our domestic manufacturers and our trading partners in Asia want gas, and they're crying out for two things: secure and affordable supply. Our relationships and strategic partnerships with countries like Japan, Korea, and Malaysia are built on the energy and minerals trade, which has been the foundation of their economies and their living standards, and importantly, their ability to invest in regional security and defence. In turn, the development of our resources for export has supported our own domestic industries with a competitive energy advantage that we need to recover. We can't do that without investing in more supply. Right now, all Australian governments should have their shoulders to the wheel to get more gas developed, to put downward pressure on prices for both the domestic market and to support our trade and investment partners in Asia. And with that, I'll move on to our presentation and my next, I guess I'm clicking these myself, am I? This could go anywhere, so apologies for that. Let's see if this works. Oh, wrong way, huh? Oh, you doing it for me? All right, cool. I wondered what was happening there. All righty. So first of all, you saw in the video this morning that Santos has rolled out its new strategy and its new vision for the organisation. Now, as you would be aware, for the last 7 years or so, we've had a strategy that served us well, our transform, build and grow strategy, which was really about transforming the base business in Santos into a lower cost operating business and building portfolio positions around existing infrastructure, around the core assets, and then growing the business on the back of that. In that 7 years or so, we've more or less doubled our production during that period of time. I think we've halved our gearing from around the 40% mark back in 2015-16. And of course, we have reduced those costs quite significantly across our business, building a stronger, more robust business around that core portfolio. But going forward, we felt it was time for a new and refreshed and invigorated strategy to help drive the business over the next 20 years or so to deliver the sort of company that we want for our shareholders and that we think Australia needs as a leading energy company over the course of the next couple of decades. And tied to our net zero 2040 plan, or our target to reduce our emissions scope 1 and 2 to net zero by 2040, our purpose as an organisation has been refreshed and the board has signed off on this, and that is to provide cleaner energy that is both affordable and sustainable to help create a better world for everyone. Now, this is something that we think our staff are very excited and very motivated in getting behind, and this is why the company exists. We are here to do that and provide really strong returns to our shareholders as we go forward. And our strategy, rather than the transform, build and grow three sort of horizon strategy that we had in place, has now evolved to a backfill and sustain strategy, which really is focused on backfilling our current infrastructure and then sustaining that production through to the mid-40s and beyond across those assets. So whether that be our West Australian assets, our Cooper Basin, our Queensland LNG asset, our Darwin LNG asset, and even our PNG operations. About backfilling these operations, the infrastructure we have, and then maintaining that production through to 2045 plus. And when we look at that, what does that mean in terms of CapEx? It means over the next 4 or 5 years, yes, we have a moderate level of reinvestment as we backfill the current infrastructure. We've got two projects on the go today with Barossa and Pikka. Of course, two projects that are in the execution stage. We've got a number of projects around our infrastructure that we would hope to progress over that period as those projects come off. And that should then leave us with our infrastructure full, and it becomes a much lower CapEx intensity business from sort of 26, 27 onwards as those projects come online. And it's really then about a sustaining operation for those assets through to the mid-40s and beyond. And then the next stage, of course, is decarbonisation. If you think we're already building the Moomba CCS project, that will be online early 2024. And so those who are going on the site visit tomorrow will get to see some progress on that project. And I'm sure Brett Woods will do a great job taking you through and explaining to you how that project is progressing. It's on schedule and very much on within budget as well. But in addition to that, we want to build our 3 CCS hubs, our 3 decarbonisation hubs and clean fuel hubs around our existing infrastructure. And that's Moomba, that's Darwin, and of course in Western Australia, where we'll be looking to repurpose some of those late life assets into carbon capture projects in the future. And as I said in my intro, not only to decarbonise our operations, to me that's just the tipping point, that's just the starting point for our decarbonisation business. We see a huge opportunity about decarbonising and providing decarbonisation services to other industries in those regions. And we've already got very strong interest from third parties for Santos to take their CO2, because we will be able to do that at relatively low cost and particularly at scale. And so we see, if you think of that CapEx profile over the next 4 or 5 years, predominantly around the backfill projects and setting the base business up, and then graduating with more focus through the second half of this decade on those decarbonisation hubs, the development of those hubs as we build them up. And then towards the end of this decade, and I don't see it really any sooner than that, we see heavily investment turning towards clean fuels projects. And why do I say that? Because the market just doesn't exist today. Quite frankly, we're not going to make a product the market can't consume. And that's why none of these projects have FID'd. Whether they're Santos projects or anyone else's, all these studies that are going on out there, the reason they're not FIDing is because the market does not exist yet. And just wishing it to be so is not going to make it happen. The fact is we have to evolve those markets. And we are working with our customers, whether they be in Korea, Japan, Malaysia, here in Australia, looking at how quickly we can develop those markets. But when you think about how long it takes to develop projects, take them through the FID, and then start construction in these projects, just going through the normal planning processes, we don't see really any heavy development in that space until 2030 or towards the end of this decade. And so our strategy is actually a very simple one, very easy to understand: backfill and sustain, decarbonisation, and then clean fuels. And we think we're in a very strong position with the hubs that we have, with the infrastructure that we have, to be a leader in all 3 of those areas over the course of this decade and beyond. If I can go to the next slide, please. In terms of how we set up our business to deliver on that, well, obviously, our upstream gas and liquids business is very much business as usual. It's a very much simplified business from a few years ago, where we had a lot of different assets. Today, I'd like you to think of that as simply an LNG business and 2 domestic gas businesses. We've got 1 LNG business that consists of 3 projects in Gladstone, PNG, and Darwin. And of course, we've got the 2 disconnected Australian domestic gas markets, the West Coast market and, of course, the East Coast domestic gas market. That's a business at the half year this year delivered around 2.6 billion EBITDAX, so a very strong cash flow generative business, and that's the sort of the focus of that sort of backfill and sustain strategy. In terms of Santos Energy Solutions, we announced the Energy Solutions Group back late 16, early 17, and we've steadily been evolving that. We've built our midstream portfolio of assets and ran them separately and broke them out from the rest of our operations so that we could run them separately. And we're bringing all that together now to build a business that comes under that banner of Santos Energy Solutions. A business that gets no revenue from the sale of hydrocarbons, 0 revenue from the sale of hydrocarbons. They have a low carbon processing objective for the existing hydrocarbons that come through those facilities, whether that be at Moomba, Port Bonython, Darwin, and in Western Australia. But also the objective of building and owning that decarbonisation and carbon management services business. And that's a range of stuff that Brett will take you through in more detail later on this afternoon, that we believe can be a very strong cash flow generative, low risk business with a very strong developing market. That market is developing much faster that we can see than the clean fuels markets because it's less capital intensive. And then, of course, ultimately building that clean fuels business. And what's particularly exciting in that area is the realization and the move, I think, externally from pure hydrogen as an export product, which we know is commercially very challenged. Not only technically is it challenged, but commercially, pure hydrogen as an export product is very challenged. And that's why we look at things like ammonia as a carrying product, but it's still quite limited in some of the uses that it can be used for. And indeed, even when we speak to our customer markets, they see that as a relatively short market, a 7-year to 10-year max window where ammonia would be a transition fuel until they can get to the desired outcome. What it's beginning to shape up like, and Brett will talk more about this in his section, is actually what we would call renewable methane. Some of you might have heard of that as synthetic methane, but we refer to it as renewable methane, where effectively green hydrogen is combined with CO2 using direct air capture technology as an example. And you're using that CO2 as a transport agent to transport it through the existing gas, LNG, infrastructure and supply chains so that the CO2 going in is exactly equal to the CO2 coming out when the product is burned. It's truly a net zero fuel. Now that is still more expensive, of course, than natural gas, but we believe that there is a pathway to bridging that gap over the course of the next decade or so. And so that's a business that today has an annual EBITDA of around the $300 million mark, but we're looking to grow that over the course of this decade as we build initially those decarbonisation projects. And of course, we've got North America with the Pikka project, which is more of a development asset. That Bruce is here today. I don't know if you all got the opportunity to meet with Bruce and Mark, who are over from Anchorage to join us for a few days this week. But if you haven't, please take the opportunity at one of the breaks and tonight at dinner to go and have a chat with them. You'll see we've got a very, very experienced North Slope team here as part of the Santos group, and that project is going from strength to strength. Next, please. We are predominantly a gas company. We do have some liquids, and so yes, we've got an upstream gas and liquids business, but we are predominantly a gas company. 92% of our 2P reserves at the end of last year were gas. When I look forward to when Pikka comes online, we'll still be an 80% gas production company. You can see from some of these metrics, a very strong balanced business. When I go forward through that pathway, as I talked about, through the sort of the next 5 years or so, taking us all the way through to 27, 28, a business with the potential to deliver around $7.5 billion US dollars in free cash flow per annum at that stage, if we're successful in building those projects. On the Santos Energy Solutions business, we've got 3 hubs right now that we are developing that we want to build to, by the end of this decade, 30 million tonnes per annum of storage capacity. With, interestingly, if I just look at the East Coast emitters alone, not including our sector, the East Coast emitters alone that are subject to the safeguard mechanism and how we view that will play out, that would create a market of at least 40 million tonnes per annum of easily captured and transportable CO2 that becomes potential opportunities for Santos to capture and store here in the Cooper Basin. From a capital management point of view, in 2022, of course, we've already returned $866 million US dollars to shareholders through dividends and buybacks year to date. And Anthea will talk more about our rolling buyback program later on this afternoon. And I think we've still got around 30 million or so to go, a little bit less than that, to go in completing this latest buyback. And of course, we'll then continue that program early next year. And of course, then we've got the strong balance sheet. As I said earlier, we've come down from around 40% gearing at the end of 2015 to just over 20% at the end of September. I think that number, the last Q3, yeah. So next. In terms of our outlook to 2030, this gives you an indication. I'm sure all the analysts will have the rulers out right now and trying to see what the number is in each year. And you can see from a production profile, I think the key information here is really, you see Bayu-Undan coming off, a little bit of decline in Western Australia from our domestic gas business over there. I would point out that that is, in this current world, that is our lowest margin gas, of course, that we do have in the portfolio today, because it is that fixed price business. It's great in a downturn. It's not so great when you're getting these commodity prices, because the price doesn't change in that market. But we see that a little bit of decline in 23, 24. But I think if you follow that black line, that's our committed projects in our base business. You can see that's a very solid, straight, relatively level baseline through to 2030. A very solid business we have as a base business before we bring anything else on. Of course, in 25, that starts kicking up with Barossa, and a bit further with Pikka in 26. And that's why we're saying that we want to sustain our business in that range of between 100 and 140 million BOEs through to 2045. Now, in saying that, current equity levels, of course, we'd go well above that 140 mark. And so we're assuming there'll be portfolio optimization along the way when we say we set that target between 100 and 140 during that period. And of course, that then assumes that we'll be building our projects. We've got a great project in the west in Dorado, bringing that project online. We've got Narrabri gas project, should that ever get developed here in the East Coast. And we see the need for it's never been greater, right? The need for it is only going to increase over the next year or two. And so I'm still optimistic that that project will come through the market, because the market needs it. And I think that realization is beginning to hit all the key stakeholders around the east coast of Australia. And I can tell you, we are well over 100% subscribed by buyers who want that gas. And they don't just want it for 1 year or 2 years. We've got long-term offers on the table, or expressions of interest, I should say, on the table from buyers for that gas for 10 plus years, 10 and 15 years, which is not the norm in the domestic gas market. So real strong demand. And that's because those buyers are seeking energy security as well as affordable energy. So you can see that's a very strong outlook for the future. Then, of course, if I look at that CO2, this is a different chart. This is not the per annum storage. This is more about the storage capacity that we're booked. You saw we booked 100 million tonnes of storage capacity in terms of 2C plus 2P equivalent at the end of last year. This assumes the 67% or so net equity interest of Santos. And as we book on Bayu-Undan and as we increase our capacity bookings elsewhere, you can see we're targeting booking around 160 million tonnes of capacity this decade. We recently got awarded some very good acreage in the Bonaparte Basin offshore Darwin, and of course in Western Australia adjacent to our current Reindeer facilities. Next, please. In terms of our free cash flow performance, I thought this was an interesting chart. You know, you've seen the sources and uses charts we've put out there at the last results roadshow. When we look forward and we think of our business in terms of the cash flow generation sensitivity to commodity prices, and we talked this year, we gave guidance in fact this year where we said for every $10 that the oil price would go above our free cash flow break even of around $25, for every $10 that would generate something like $450 million in free cash flow. And I think at the half year and the third quarterly report, we're right on the money for that forecast. So very accurate forecast. Now we see that dipping to just under the 400 mark in 23 and 24 as production comes back a little bit, but you can see how it jumps up rapidly in 25, 26, back up to 550, and then over $600 million in 2028 onwards. And so a very strong cash flow generation. And when I talked about that CapEx earlier on, through the next couple of years, what's really important to recognize is as Pikka comes online, as Barossa comes online, and by mid-2026, we've completed paying our project finance debt on the PNG LNG project. That should liberate around another $2 billion in free cash flow at our long-term planning prices, around $2 billion in free cash from the current levels of cash flow generation. So that's a very, very strong cash flow generative business from 26 onwards. And then that takes another kick up in 28 once we've brought online the other projects in that portfolio, the Dorado, Papua LNG, for example. I think a very important metric that we track internally that we wanted to share with you is the free cash flow per share that we look at. That's a very important metric for us. And you can see, obviously, in 2015, it wasn't so healthy, but you can see that trajectory as we have streamlined and transformed the business over the last 5, 6, 7 years, that we've continued to strengthen that. And we'll stay very focused on that free cash flow per share generation as we continue to go forward. And of course, buybacks help with that in a small incremental way, but over time, of course, they help with that also. Next, please. In terms of the free cash flow sources and uses, we have made a change to this chart since you last saw it. And we talked previously about showing you the sort of $65 sort of cash flow generative sort of view of the world in terms of sources. And the $100, the sensitivity to that oil price. And through the feedback loop we got from the market, it was obvious that we'd missed a bit of a trick in not also including spot LNG exposure. And so we've shown you here that that bottom one assumes a spot price of around $10 per MMBTU for LNG, and you can see how that changes even just going to $16 per MMBTU as a longer term sort of spot upside case. And what that has done, you can see how that's markedly increased that potential free cash flow generation from the business. Now, of course, we've got $7 billion or so of committed projects, and there are other projects in the pipeline that we would look to fund over the mid part of this decade, as I talked about earlier on. But you can see there's very significant free cash flow potential, obviously depending on commodity prices. I'll put that qualifier out there, from this base portfolio. And that gets particularly strong in the second half of this decade as we move into a lower capital intensive business phase for the company. And we start to generate much stronger free cash flow from those core assets. Of course, we can't do any of this stuff we're talking about unless we're a reliable and safe operator. And I'm really pleased to see that despite my disappointment that I communicated to our shareholders back earlier this year from 2021 safety performance kicking back, reversing the trend of improvement we'd seen over previous years. And, we do believe there was an element of COVID fatigue and all of that. Our workforces all over the country and in PNG went through very significant pressures and stresses, working long periods away from home. We had employees up in Bayu-Undan, for example, who would do 8 and more weeks away from home because they had to isolate before going to the facility. Then they had to isolate when they came off the facility to be allowed back into their home state in Australia, plus the time, of course, in between the 4 weeks or so they're working at site. And that became very, very tiring and stressful, as you can imagine, over long periods of time. We had some workers, with a Victorian worker who works in Western Australia, who spent more than a year away from home from his family because of the border restrictions in Australia. And those things do take their toll on employees. And we saw that safety performance, albeit mainly slips, trips and falls, not many high potential incidents, mainly slips, trips and falls, but we saw those incidents increasing in 21. Really pleased to see in 22 we're back on trend. We've got those trends back in line and back with our more normal levels of performance, despite having bigger activity. We've got projects up and running, we've got operations in shipyards overseas, and of course we've got a much larger workforce now in PNG that's been working with us this year, all doing a great job. And that takes me to my next chart, because this is really the slips, trips and falls, that injury frequency is where lost time incidents occur. The ones that really keep me up at night and should keep us up at night as operators are, of course, loss of containment. When gas or oil escapes from your process plant or from your pipelines, that has the potential to have large process safety incidents. And you can see a performance improvement over the years has been very, very consistent. Now, what I should point out, this is not a particularly great metric for a growing business, because this is absolute events rather than frequencies. And you can see it looks like the tier 1 in blue has slightly gone up this year, and that's true, it has. But of course, we've got a whole new field and a whole new operation in PNG that wouldn't have been part of the portfolio before. So just based on the number of assets, the number of activities going on around the company, when we put that into frequency terms, like we do with the HSE incidents, the trend is very much downward. And so we're really pleased to see that we're continuing to drive those loss of containment events out of the business, because that is ultimately our number one metric for process safety and ensuring that we're running safe and high integrity assets across our portfolio. In terms of emissions, of course, you know, we can't have a discussion about how the business is performing without talking about our emissions. And with our energy solutions business, it's very focused on decarbonising our business, but also decarbonising industry and making some money along the way. We're not ashamed to say that. You know, we think we'll grow that business much faster if it's a commercial business. We're not looking at this as a defensive strategy. This is very much an offensive strategy, because we want to build a profitable business that helps the world decarbonise. However, our internal targets, our 2025 targets, I'm pleased to say we're on track to achieve all of those early. And I think hopefully by the end of this year, we'll have achieved the emissions reduction, the 5% emissions reduction target set for the Cooper Basin and Queensland onshore operations by the end of this year. That's on track. And if it's not the end of this year, it'll be early in 2023. Our LNG, as much as I take satisfaction in growing that business, that is really about driving coal to gas switching across Asia. Unfortunately, what we've seen because of high gas prices, due to the foot on the hose preventing more gas supply, what we've seen for the first time in many years, I think over a decade, is gas to coal switching globally. And as long as governments and government policies around the world slow down OECD reliable supply of gas to these markets, we're going to see more of that, and that will drive global emissions up. So as much as I'm satisfied that we have achieved our part of that target, I'm disappointed the world has moved the other way and we're actually seeing gas to coal switching because coal is abundant and available. Not because it's cheap, because it ain't cheap these days. Coal is not cheaper, but it is abundant and it's available. And that's what's driving that switching. Because when you ask people to choose between heating and eating, they want both every time. They want both every time. They don't want to have to make that choice. They want to be able to heat and they want to be able to eat. And finally, the new technology, of course, hopefully Brett will cover this tomorrow when you're out at Moomba, but next year, first half of next year, we will be the direct air capture technology in the Cooper Basin. And that is something that we're really excited about. The technology that we are trialling is targeted as being the lowest cost direct air capture technology in the world that we're aware of today. And that is something, as I said earlier, ties into new technologies like our clean fuel strategies further down the line. So we're very excited about the trials. We'll be piloting other technologies, other direct air capture technologies over the next couple of years in the Cooper Basin as well. But our first trials will begin in the first half of next year. And of course, we've summarised here our 2030 and 2040 Scope 1 and 2 targets as well, with the net zero Scope 1 and 2 emissions target by 2040. Interestingly, I thought it was also worth pointing out our policy that was launched some time ago now has a commitment to only selling our products to countries, to customers and countries, and from countries that have either got a net zero commitment or are signatories to the Paris Agreement. And by definition, that means they are taking 3 of our Scope 3 emissions. They are reducing their Scope 1 and 2 emissions to net zero in accordance with the Paris commitments. And of course, any final investment decisions that we take on new offshore greenfield projects from 2025 will require abatement or offset reservoir CO2 emissions. And that'll be our standard for any projects post-2025. Now, I think that's the end of my session. We're going to have time later on for some Q&A. I'm going to hand over to Jane Norman now, and Jane's going to take you through our market outlook. Good on you, Jane.
Thanks, Kevin.
Cheers. Feel free to applaud.
Great. Thank you, Kevin, and good afternoon, everyone. I'm Jane Norman. I'm Vice President of Strategy, and today I'd like to present the market outlook. So firstly, focusing on the global energy mix. Today, around 80% of global energy supply comes from hydrocarbons. It's clear that hydrocarbons cannot be replaced overnight, which is why here at Santos, we're intent on delivering a just energy transition that focuses on decarbonisation, not defossilization. A just transition that delivers energy security, reliability, affordability, and lower emissions for all. The world has an insatiable demand for energy because it fuels human development and improves living standards and economic prosperity. But right now, geopolitical unrest and government policies, as well as activism, are impacting global gas supply and sending market prices to new highs. High natural gas prices and lack of available supply have resulted in fuel substitution in electricity markets in favour of coal and oil, leading to higher CO2 emissions and local pollution, which is impacting air quality, especially in major urban centres. In 2021, global energy-related carbon emissions rose 6% to 36 billion tonnes of CO2, their highest level ever, as the world economy rebounded strongly from COVID and relied heavily on coal to power that growth. Without new investment in lower emission energy supply, access to affordable and clean energy, one of the United Nations Sustainable Development Goals, will remain unobtainable. According to the IEA's World Energy Outlook, which was just released last month, some 75 million people who recently gained access to electricity are likely to lose the ability to pay for it, meaning that for the first time since the World Energy Outlook started tracking this, the total number of people worldwide without access to electricity will actually start to rise. And almost 100 million people may be pushed back into reliance on firewood for cooking instead of cleaner fuels such as gas. So as the world focuses on achieving net zero emissions, our focus is on decarbonising the current energy mix, as well as achieving new low-emission fuels and technologies. Looking at the fuel mix, today 80% of energy is consumed as fuels. Only 20% is consumed as electricity. That has barely changed in 20 years. And the forecasts show that over the next 20 years, fuels are expected to account for 75% of global energy consumption. Natural gas is a critical fuel to the future, with gas consumption forecast to rise 20% by 2040. Gas has an important role to play in supporting the integration of renewables into the electricity mix, providing flexible baseload power as well as reliable and firming power. It is fuels that are the lifeblood of the Australian economy. They power the resources sector and manufacturing. They meet residential demand for space heating, cooking, and hot water, where in Australia 7 in 10 households use natural gas. Gas is a necessary feedstock for manufacturing, industries such as fertiliser, everyday products such as packaging, clothing fibre, and medical devices. In fact, more than half the world's gas is consumed in sectors other than power generation. Renewables can help meet the demand for the 20% of energy consumed as electricity, but renewable energy requires conversion to new fuels like hydrogen to meet the demand for fuels. Santos will continue to focus on supplying reliable, affordable, lower emission fuels that the world needs, as well as developing new fuels like hydrogen when our customers demand it. Turning to the global oil outlook. What we know now is that the demand collapse in 2020, driven by COVID restrictions, masked the underinvestment in new energy supply. And now the war in Ukraine has further restricted supply and brought energy security back into sharp focus. Energy security, reliability, and affordability are now front and centre for all governments. Today, OECD countries consume 50% of global liquids, but only produce around 20%. The US is the world's leading OECD producer of oil, roughly half of OECD production. Without the OECD supply, demand will be met by OPEC+. This means the world relies on the Middle East, Africa, and Russia for its energy supply. In response to the energy crisis, we've seen the Biden administration just last week call for US energy companies to act in the interest of their consumers, their community, and the country, and to invest in increasing production and refining capacity. Oil demand is set to remain strong for the foreseeable future. Santos is investing in the Pikka project in Alaska, and this is the right project at the right time. It provides further OECD supply and energy security. The project has strong fundamentals. It is located in a world-class oil-producing province with significant existing infrastructure. It is going to be developed as a carbon-neutral project and is well supported by local stakeholders. LNG, likewise, strong demand. We see demand growing by 70% to 2040. With Russian pipeline gas flows to Europe, a third of what they were 12 months ago, Europe has no choice but to maximize LNG imports, given the uncertainty over Russian volumes. To offset Russian gas supply, Europe is set to import an extra 34 million tonnes of LNG in 2022 compared to a year ago. Currently, it's expected that Europe will install up to 80 million tonnes of additional regas capacity by 2025. This is roughly equivalent to Australia's entire LNG supply, and it's worth noting that that supply took 30 years to develop. The global LNG market is expected to remain undersupplied, even with the new US and Qatari volumes coming on from 2026. In this tight market, LNG will flow to the highest price markets, and poorer countries will have to turn to cheaper fuels, higher emitting fuels, or face energy poverty. Today, Asia Pacific accounts for around 62% of global LNG demand, down from 70% a year ago, and that's due to the increased consumption from Europe. Over the past decade of globalization, customers grew comfortable with free markets, liquidity, and access to short-term volumes. But with demand outstripping supply, Asian LNG customers are once again focused on energy security and looking to lock in new LNG supply. We are seeing interest in 10, 15, even 20-year offtake agreements. Longer term, US LNG is expected to set the global LNG prices, with Henry Hub gas prices driven up by inflation and financing costs. The delivered cost of US LNG into Asia is expected to be in the range of $10 to $12 an MMBTU US. Following the merger with Oil Search, Santos became the 6th largest independent LNG supplier globally, with supply from 3 projects in the Asian region. Santos's LNG portfolio is well located for these premium Asian markets, with relatively short shipping distances and alternative shipping routes, providing buyers with energy security. The portfolio is diversified by project, geographic location, again providing further energy security to buyers. Santos is well placed with a suite of options to meet customer demand for both near-term and long-term LNG supply. As the PNG LNG mid-term contracts roll off in 2023, this supply will become available and can be potentially sold into the spot market. We aim longer term to have around 25% of our LNG project portfolio exposed to the JKM price linkage from around 2025. Closer to home, we have not been immune to the factors driving the global energy crisis. On the East Coast, spot energy prices soared earlier this year as a cold winter snap set gas, coal, and electricity prices to record highs. This triggered gas price caps in Brisbane, Sydney, and Melbourne at $40 Aussie a gigajoule. The cold snap, however, was not the cause, but rather the catalyst that highlighted the following market shortcomings: low renewable power generation from solar and wind, coal outages and supply shortages, in part caused by wet weather, and also the export of coal to higher international price markets. Significant underinvestment in new energy supply due to activism and regulatory uncertainty. The reality is that Australia's southern gas markets, as shown on the slide, require new supply, and the market is increasingly reliant on Queensland gas being directed south. In the absence of new supply, the East Coast faces LNG imports. Today, we estimate that LNG imports would cost around $50 Australian a gigajoule delivered to Sydney, putting many manufacturers out of business. Phase 1 of Santos's Narrabri gas project can add a further 80 TJs a day of gas to this market with potential to ramp up further. Santos has committed 100% of this project to the domestic market. With the federal government forecasting power bills are going to increase over 50% in the next 18 months, new energy supply is the fastest and most efficient way to bring prices down. And Santos' Narrabri project can provide affordable gas to the market at significantly less costs than imported LNG. On Australia's west coast, in 2021, Santos provided 45% of the domestic gas supply, and we continue to see strong demand from large industrial customers. And although the demand outlook remains strong, the market remains finely balanced with new supply required from 2025. Turning to CCS. CCS is a proven and critical technology to meet the goals of the Paris Agreement. CCS is expected to play a critical role in global decarbonisation, providing low-cost, large-scale emission reductions. Fatih Birol, the IEA's executive director, has stated that reaching net zero goals without CCS is almost impossible. The world doesn't have a faster or more affordable way to reduce emissions. Over the past year, we have seen more than 60 new CCS facilities added to the project pipeline. This brings the total number of CCS projects globally in operation or under development to more than 180, with a total storage capacity of 220 million tonnes. However, this is still a drop in the ocean compared to the almost 1,200 million tonnes of CCS required by 2030 to meet the IEA's net zero roadmap. We are confident that Santos has a competitive advantage to progress CCS and decarbonisation services with sanctioned Moomba project, the Bayu CCS and the offshore WA project. Our CCS hub strategy across our core assets has the potential to create more than 30 million tonnes of CCS capacity. Globally, carbon prices have continued to rise as governments and companies work towards their net zero goals. European carbon prices are up 150% since 2020, and Australian ACCU's up 60%. The international voluntary carbon offset market is gaining recognition, with prices up more than doubling in the last 2 years. We expect these trends to continue as producers and consumers commit to their net zero goals and look to abate emissions. We see these higher carbon prices supporting our Santos Energy Solutions business as customers and consumers look to cap their liability and manage exposure to rising carbon prices. Through our CCS services, we can offer customers and third parties large-scale, low-cost emission reductions. CCS is an enormous opportunity for Australia and one that can support the government's goal for net zero emissions by 2050. Around the world, we have seen governments are recognising the role of CCS in reaching net zero goals and incentivising greater levels of CCS investment. The Indonesian and Malaysian governments are allowing the cost for CCS to be recovered under their production sharing contracts. The US has implemented funding for CCS through its Infrastructure Investment and Jobs Act and more recently in the Inflation Reduction Act, which has increased tax incentives to $85 a tonne for CCS and a further $180 a tonne for direct air capture. Canada has established a $1.9 billion tax credit scheme for CCS. In Europe, Denmark has announced $5 billion in subsidies for CCS, and Norway has announced significant funding for CCS and blue hydrogen projects. Australia has the opportunity to become a CCS leader, and as a country, we should not miss this opportunity. To wrap, Santos is committed to supplying critical fuels such as natural gas to meet our customer demands. The world continues to rely on hydrocarbon fuels for its primary energy, and we expect fuels to remain strong for decades to come. We are committed to producing fuels that are affordable, reliable, and progressively cleaner. Thank you, and I'd now like to hand over to Brett Darley, our President of Upstream Gas and Liquids.
Right. Thanks, Jane.
Thank you.
So look, we try to keep it simple, certainly in the upstream business. I think Kevin's done a good job. We've got Brett, and unfortunately we were looking for another Brett, but we got a Bruce, which for an American's a pretty Aussie name, so you're pretty close there, Bruce. That's a good Aussie name. Maybe next time. So look, Kevin's already discussed the upstream division's role is to backfill and sustain production from our core assets past 2040. It is simple. Develop around our privileged infrastructure through our discovered reserves, resources and existing acreage. Continue our focus on our low-cost disciplined operating model to maximise the opportunities in those areas, and to manage our project capital in a phased and disciplined manner. And we're blessed with having more good projects than the capital that we have, so we need to be disciplined, and it's a great problem to have. And this will deliver the cash flows needed to execute our strategy and purpose. I'm not going to go through the LNG business again. Kevin went quickly through that, but again, very simple. Gladstone PNG, Papua 1 sanctioned, Bayu-Undan and Barossa to DLNG in our two domestic gas businesses. We also have liquids production, associated liquids from our gas assets themselves, and a couple of standalone assets in WA. And on a particular note, Pyrenees, with our joint venture operator Woodside, is just commencing a Pyrenees infill program, and we will see or expect to see production from that before the end of this year. And I'd like to say again, I'll mention the EBITDAX of $2.6 billion in the first half of 2022. I might say it again, $2.6 billion in the first half of 22. So Santos LNG portfolio, we continue to plan our 3 LNG strategies with a disciplined and phased approach to sustain the production past 2040. At PNG LNG, we've got an incredibly strong pipeline of backfill opportunities and core asset extensions, including Angore, which is about to be spudded this year by our joint venture partner ExxonMobil, the associated gas project, which fits in the new merged company, which will increase our current Santos operated gas into the PNG LNG project, and also Papua LNG in the midterm. P'nyang is also future backfill. It's a low CO2 project, but the Santos Energy Solutions team under Brett Woods is already exploring nature-based opportunities for that asset. On Gladstone LNG, we continue a phased development plan across our base acreage with our joint venture partners, Total and Petronas, and I'll show you some detail on the progress in a moment. It's already a low CO2 asset, but we're progressing on electrification renewables. And at Darwin LNG, it's about sweating Bayu-Undan until the end of field life, and it's about getting Barossa online. It's a fantastic project coming at the right time. It's been modified since the acquisition to be CO2 export ready, and we have some amazing potential for CCS again that Brett will take you through. So a quick look at PNG LNG and GLNG upstream performance. Really the big one there is a step change in production with the PNG merger with Oil Search. PNG LNG is maintaining strong gross production at approximately 8.6 million tonnes per annum in 2022, and with more than 20% above forecast for spot cargoes. We are currently delivering from our operated assets around 14% of the PNG LNG project gas, and that will be increasing over the next few years. We are progressing Angore with Exxon, who's operating to backfill PNG LNG, and that is due to be spudded this year as well. We are commencing in 2023 an infill drilling short cycle oil campaign to take advantage of our remaining higher margin oil reserves. A quick look at 2022 costs, as well as taking on in the merge of the high margin oil production associated with the Oil Search transaction. We also had an increase in activity, not just operated and non-operated, after a couple of years of COVID restrictions. And on the integration, we've worked hard this year to deliver on our synergy targets while ensuring safety and production was not compromised. And we've embedded this in our forward budgets, and Anthony will take you through some of the results there as well. On the upstream Queensland, the CSG production continues to build year on year, so every year we are increasing our equity production. And despite the 2022 weather challenges, not as big a challenges as we've experienced in the Cooper Basin, we have again exceeded our equity production year on year. Development programs in Roma, Scotia and Arcadia are delivering the production build, and surface to in-seam wells in Arcadia and Scotia are exceeding expectations, which will allow us to access additional gas reserves. And we've been able to keep our production costs flat even as we add 300 wells per year to our developments. And this is due to improvements in artificial lift run life and improvements in field reliability and remote operations. So here, just going through a bit more detail on the GNG production costs. Despite all the difficulties with the weather this year, we've maintained our low cost focus. Production has exceeded 700 terajoules a day during the year, but has been impacted by weather and the ability to keep some of our high performing wells worked over. We expect a full field recovery following the end of the La Nina event. And we continue to execute a standardised drill complete connect model that supports continuous learning and performance improvement. And you can see in that top right chart, as mentioned, the continuous improvement of artificial lift technologies and reservoir management, increasing mean time between failures by around 450%. That's less people having to go out to the field, that's less workovers, and our big costs are maintenance of wells and people, and this reduces that substantially to keep our unit costs down. On Bayu-Undan, looking at what we've done in the last year or so on Bayu-Undan, we've extended the field life up to a year as a result of sweating the remaining reserves and resources. The chart below in the bottom left that shows you what the profile would have been if we hadn't have done the 3 infill campaign and the well interventions, and that was what the prediction was without those activities. We completed a 3-well infill campaign approved post-acquisition in a very short time frame to take advantage of the remaining facility availability between Bayu-Undan production and Barossa. And this was great collaboration between the ANPM and Timor-Leste and our joint venture partners to capture that opportunity. We implemented an aggressive well intervention campaign providing fast turnaround water shutoffs and reperforations to maximise production. And we've been relentless on our offshore and onshore plan optimisation, reducing facility pressures to get the last remaining reserves out and reducing minimum production thresholds for LNG given the high price environments. The increased production from these activities more than justify the asset purchase price and has come with the increased equity and operatorship of Barossa and Darwin LNG. A quick update on the Barossa federal court case. As previously advised, the Barossa drilling operations have been suspended following a federal court decision to set aside the acceptance by the regulator of the drilling and completion activities environment plan. We did have an approved drilling and completions activity plan before commencing operations. Santos is appealing the decision with a hearing on the appeal expected to be held in mid-November. We are also progressing a new environment plan and we're working to expedite this. We're currently 45% complete on the project and the drilling activities are not on critical path for startup at present, and we have headroom in cost and project schedule against contingency. So quick look at the Santos domestic gas portfolio. In the Cooper, large resource base, and we continue to open up developments here through our low-cost operating model. And I'll speak to some more of that in the next few slides. On the decarbonisation pathway, again, Brett will cover that with Moomba CCS. On Eastern Queensland, our production here is dominated by APLNG operated assets of Spring Gully and Combabula. Both are continue to be developed by our partner, and we have reliable production forecasts on that. In addition, Santos with Comet Ridge are joint venture partners in the Mahalo CSG project, and we're continuing with Tor McCall and his team at Comet Ridge to finalise the development plan, and we're expecting to enter FEED next year. It's expected the Mahalo project design will be based on recent successful developments in Arcadia and Scotia. In WA, we've got operational synergies realised through our 100% operated assets of Devil Creek and Varanus Island, as well as our non-operated position with Woodside at Macedon. They're high margin assets with CPI contracts. They generate significant cash flow and provide a natural hedge against oil price in the portfolio. And I'll talk a little bit about the lower expected forecast in 23. So Cooper, 3 La Nina events this year in the Cooper Basin has strained our ability to maintain the development program. The constant rain and flooding has limited our access to roads and prevented well connections. This has been unprecedented. So in the last 5 years, when we look back, this is double the worst year of the last 5 years to the first half of 2022, and it continues to rain. Despite this, we've done a number of things to maintain production and continue to pull that program back, including an additional drilling rig, 12-hour moving our workover rigs from 12 hours to 24 hours, additional frac spreads, and we have actually reduced our connection times by 50% when we get a dry run. On the drilling performance, as far as our reservoir results are, we've only had one P&A for the year, so that is an excellent result year to date. And we're back to our 100 wells for the year. We will be doing 100 wells this year, regardless of the weather. And we have 30 wells ready to be connected right now. So again, fingers crossed for a bit of sunshine, and we've got an inventory of wells to be connected. So for those coming up to Moomba tomorrow, you'll get to have a look at the drilling rig that's currently on this play. So this is an exciting play, right in the heart of Moomba, and it leverages our low-cost operating model. It's a large play. It's close to existing infrastructure, drilling simple vertical wells, and we're even getting some additional fracs in the granite wash below. So we're fracking in the Patchawarra, simple, cheap, repeatable, and getting some upside from fracking in the granite wash as well. We're doing this with pad drilling, and it's reducing rig move times, infrastructure, and our ongoing OPEX. That's a low reservoir risk, repeatable drilling. And we've actually have 8 appraisal wells online already, and we've recently brought our first 3 well pads online at greater than 7 million scuffs per day. So we've now got 2 drilling rigs operating, one in Moomba and in a similar field, Big Lake, and we've got the potential for this to be a long-term play with rigs tied up there for numerous years. Low cost, very low reservoir risk, base production, allowing us to have a really full inventory. So just on WA domestic gas, as mentioned by Kevin, we've got a lower gas production forecast. However, we have our Spartan development currently being executed as we speak. So this is the next development back into the existing infrastructure. The jackup's on site right now. We have a subsea construction vessel in the field, and that has commenced installation of the tieback for that well. This will be the first new gas well tied back to these facilities in 10 years. In addition, we've got a number of plays and a number of opportunities around our infrastructure that are being progressed right now. So back to discovered resources close to infrastructure to fill our facilities. And this includes an infill well at Spar Halyard, and also the development of a Spar Deep play and Corvus gas discoveries. The Spar Deep reservoir lies beneath the producing Spar Halyard fields. They have been penetrated by the Spar wells, and they can be tied straight into the East Spar pipeline. In addition, Dorado is a project that allows for development and production of both liquids and gas. Over the long term, we have our discovered gas resource in the Bedout Basin at Dorado and Rock to support the WA gas business. In addition to these discoveries, we're excited by a number of gas opportunities that are available within our acreage position to further add gas to our volumes. And as part of a Dorado review, we're considering options to not only include Parvo in the base development, but accelerate the timing of gas export from the development. So on our upstream unsanctioned projects, we've got a pipeline there. Dorado, as I've just mentioned, remains an important project for Santos. And in conjunction with Adrian Cook and the team at Carnarvon Energy, we are progressing revised timelines for development. As I've said, it's important to note that it consists of both gas and liquids, and a gas export opportunity for these to support the WA gas business is certainly one of our plans. We've also had exploration success this year, early in the year with the Parvo discovery, and we're excited that looking at our seismic that it opens up a number of gas and liquid opportunities to the basin to add to that portfolio. On Narrabri, our continued focus on optimising costs using our experience, technology and discipline that we've honed in Queensland have substantially reduced our unit costs and potentially allowed a larger single initial stage development. We've acquired the Hunter Gas Pipeline to ensure that we're enabled to control the route to market, and our spring survey access approvals on the pipeline are currently being progressed. And on Papua, which I touched on before, we're working with the upstream operator Total and the downstream operator ExxonMobil on plans to optimise that development to maximise value, and we expect feed very late this year. The project is an incredibly competitive LNG project that benefits from brownfield synergies at PNG LNG and the proximity to the Asian gas markets. And lastly, I'm just touching on decommissioning. We continue to progress our activities in a disciplined, phased and focused way. We approach these obligations by continuing to backfill our current facilities and looking for opportunities to keep them producing for longer, looking for repurposing opportunities of our existing facilities like CCS, and continually progressing decom liabilities with a disciplined approach every year. So a couple of examples onshore, we have taken 700 pipelines out of service in the last few years. We have plugged and abandoned 50 wells. Offshore, just this year, we have decommissioned the wells on our largest non-producing platform at Harriet, and we've continued to support our JV partner, Chevron, in the abandonment of Thevenard Island, and you can see some of the work they're doing on the island to remove tanks and rehabilitate. And we're continuing to look at a phased decommissioning plan for Bayu-Undan post-production in anticipation of transforming it into a CCS hub. So that's all I've got. So Bruce, I'll introduce Bruce Dingman, our President of Alaska. Bruce, good to see you, mate.
Thanks, Brett. I like the Brett and an American named Bruce joke. I wished I could say my wife's name was Sheila, but it's not. Anyway, I know that you're all probably about ready for a comfort break. We've got 4 slides here, so I appreciate your patience as we work through these. And then we'll be on to the Real-Time Operations Center and a break. I guess on this title slide, before we get to the meat of the material, I did want to talk a little bit about our FID decision that we took in mid-August that I'm sure you're all aware of. But prior to that decision, we had a lot of preparation work. In fact, our engineering level got to a high level of definition. You know, typically when you take FID on a major project, the engineering degree of completion might be 30 to 40%. We had scopes that were up to 70%, so we took a very high level of definition into that final investment decision. We also did a lot of work on our contracts, so we had a lot of the key contracts prepared, fully negotiated, and ready to go at FID. So what that allowed us to do then is to move at pace once FID was taken. Additionally, we've assembled a really strong team in Alaska, and we're well positioned now for that project execution and for field operations. And just to give you a rough sense, we got about 150 workers in Alaska that are Santos staff, and that represents about 1,500 man-years of oil and gas experience. But importantly, that's about 1,200 years of Alaska experience relative to our, and pertinent to our project. So we've got a really good team. We did a lot of preparatory work, and we're really well positioned for execution prior to having taken that FID decision. So with that, and because of that, we're off to a really good start. So if I could jump to the, I guess I can do this, yeah, thanks. Thought it'd be helpful maybe if we got oriented a little bit first. You can see the map of Alaska here. This is the state capital, Juneau. There's not much that happens there. That's supposed to be a joke. And then Valdez is the marine terminal. That's where it's an ice-free port. That's where crude can come in and out or be exported out of the state. And then this is the Trans-Alaska pipeline that runs north up to the North Slope. So that's about a 1,400 kilometer pipeline, 48-inch diameter, with a lot of ullage. So there's space in that pipeline for our crude to flow, that existing infrastructure. And then you can see the Pikka field up on the slope here. That's where we're developing our project. It sits about 400 kilometers north of the Arctic Circle. So just a bit of trivia, November 23rd, the sun will set at Pikka, and it won't come up again for about 3 months. So that's how far north we are. And interestingly enough, you might ask that, well, wintertime, there must not be much activity. It's actually the opposite. That's when a lot of our activity is undertaken because the ground's frozen, gives easy ingress, egress, that kind of thing. And then the last point back down here, Anchorage, that's where the Santos office is located. They told me that if I walked past this line, my head would explode, so I'll switch to this slide for this part of the map. So this is a zoom in from that state map. And you can see this is the Trans-Alaska pipeline that I talked about, comes up to the Prudhoe Bay field. That's a large legacy field. And then as you work your way west, this dark blue acreage represents the Santos leasehold position. And we've got three well-defined units there. We have the Pica unit, that's where we sanctioned phase 1 project. We got the Quokka unit to the east, and then we have the Horseshoe unit to the south. And in addition, we have a fair amount of leasehold that's yet to be unitized. That core leasehold is between the ConocoPhillips operated Kuparuk field to the east and the ConocoPhillips Alpine field to the west. And there's a regulated open access pipeline called the Kuparuk Transportation Pipeline that runs west to east into this TAPS line that also has ullage in it to take away our crude. So that's just a bit of an orientation of where we're at for those of you that may not be as familiar with Alaska. So jumping into our project execution, the first 4 lines on this slide talk about a couple key attributes of our project. So first oil is going to be 2026. That's our planning case, and we're looking for opportunities to accelerate that after Kevin said that we were sandbagging. So hopefully we can do a bit better than that. We develop about 400 million barrels of gross resource. That'll be produced at about 80,000 barrels a day for a 6 to 8 year plateau duration. So that fits with some of the materials you heard earlier about the sustained production performance. The capital cost for the project is $2.6 billion gross. That gets us to the nameplate capacity of the facility. There'll be sustaining capital after that at a lower level of spend. And our share of that represents about $1.3 billion using our 51% working interest share. The remainder borne by our joint venture partner, Repsol. And you know, I think that covers the key attributes of the project. If we move on now to the 5th line in that table, it talks a little bit about, I'm not ready to go to the next slide yet. I know you're ready for a break, but bear with me here. The 5th line talks about execution and contracting, so I'm going to break that into two chunks. All our major permits are issued. We have all the regulatory authorizations to proceed. And you may recall from those of you that have followed the project, we actually did our civils work in 2020. So we've put the gravel road and infrastructure and pads in place through that construction effort. So that's already in place. From a contracting standpoint, we've applied the typical criteria when you contract a big project, looking at both technical and commercial factors. Also things like safety, environment, Arctic experience, and importantly, local content and other factors. Our contracting strategy involves about 90% of our goods and service will be sourced out of North America. So that helps reduce supply chain risk and also improves some of our logistics for delivery of goods and equipment. We've also taken an approach to try to minimize cost risk, and the way we've done that is we've set up several large engineering, procure, fabricate contracts that are fixed price in nature. So of our total spend, about 60% of that is fixed. The remaining 40 represents contingency and some unit cost labor. So we feel like we've really well positioned the project in spite of the inflationary environment that we're in to maintain our promise on cost and schedule. The contracting is progressing to plan. Like I said, we had all this work up front prior to FID, and in the short 2 months since that FID period, we've already awarded about 30% of our total contract value. So we're off to a really good start there. In terms of execution, just last week we mobilized our first camp for commencement of construction activities on the slope. It's a 185-bed camp, so that's now being put in place. We've started cutting steel and welding connections at the processing facility fabrication site in Airdrie, Alberta, which is just north of Calgary. So that's well underway, as well as work with other contractors and suppliers. Now we'll be proceeding to excavate for well cellars and install conductor pipe to ready for our drilling rig, which will arrive on location in April. And then we'll have a spud in the first half, spud our first well in the first half of next year. Also this winter, we'll also be installing piles, so that these are the vertical pipes that will underpin the facilities they'll set on top of. So we'll do a large pile installation program this winter. And then we also have a number of projects I'm going to talk about later that are supportive of the community. And that's helped drive really good stakeholder alignment for our project, but I'll touch on that in a minute. If you jump to the the sixth line on the slide there, it talks a little bit about utilizing existing infrastructure, and I think I described that on the map about the pipelines and ullage and whatnot that we have good access to. In addition, there's a large service base called Dead Horse that a lot of our suppliers and goods and services come out of that we'll be utilizing. And I'll let you read the rest of the details on the existing infrastructure item. The second to last line on the slide talks about our low emissions intensity. So in the design phase of our project, we went to great effort to really reduce our carbon footprint for the project. So we use a fully electrified kit, gas turbine power generation. We're doing best available technology for all of our rotating equipment and all that. Where we do use heat for processing and building purposes, we use as much waste heat from our processing from our waste heat recovery units to meet that need. And then altogether, these factors really gave us a low intensity for our project. We'll be below 14 tons of CO2 equivalent per 1,000 barrels of oil produced, which would benchmark us in the top quartile of new greenfield projects. So a very low carbon output to start with. I'll talk in a minute about how we're going to abate the remaining carbon that we do output. And the last item on the slide is the pricing. And for those of you that run financial models, we have a benchmark called ANS, Alaska North Slope, WC for West Coast, and it ties roughly to Brent. It's within 50 cents to $1 typically of Brent pricing. So that's an update on the execution. I thought we could jump to the next slide and talk a little bit about our stakeholder approach. So when we say stakeholders, it's more than just the community. We talk about the village nearby, the borough across the North Slope, and the state, and all those are supportive of our project. And the reason why is that Alaska is really a natural resource state, and oil and gas underpins the entire economy of the state. So that leads to a natural alignment of stakeholders to see our project go through. The second line, as I talked about, we have all our major regulatory approvals in place, our civils program complete, and our execution activities underway. The third line talks about our environmental focus. You know, just one bit of trivia here, our drill pad for this phase one, we have one drill pad. It's about 21 acres of gravel that the wells will be drilled from. That pad develops between 10 and 20,000 acres of subsurface. So it's a very small surface footprint to develop a very large subsurface area. That gives us a much smaller environmental impact. And I already talked about the low emissions intensity of the project. The fourth line about community support, we have a life of asset land use agreement with the indigenous people in the area that assures us surface access to our development. And we also incorporated a lot of feedback from the community and other stakeholders when we were permitting and then when we were designing our plan. So for example, we had 20 some odd changes to our project that were based on feedback from input from those parties, and then we took a large number of mitigation measures as well. So an example would be our drill site. We actually positioned it back from the river so it's not visible when people are using it for subsistence hunting purposes. A mitigation example would be we use downlight at the rig so there's no light pollution for the nearby village. So we've tried to be very sensitive and responsive to the local community in that process. The fifth line talks a little bit more about our community projects, and these are pretty significant. We're doing a new wastewater treatment plant for the village of Nuiqsut, which is the closest community to our activities, bridge replacement in that village, and then importantly, off our drill site, the Ninishuk Drill Site B, we're doing a gravel road and then a boat ramp that allows for community access to the main navigable riverway there. And so that'll be put in this winter. And all that work, again, helps drive with alignment of our stakeholders. So if I could jump to the last slide, please. So I talked earlier about our low emissions intensity, that 14 tons per 1,000 barrels a day of production. So what are we going to do with the remaining? We've pledged, as Jane talked about in her section, to be a net zero project for our equity share. And we've taken the first steps to secure that offsets to make sure that we realize that outcome. We've got a near-term one where we've worked with one of the native corporations, the ANC, Alaska Native Corps, And that's one that's a nature-based project through improved forestry management that has potential to offset our phase 1 emissions. Additionally, we've got a second memorandum of understanding with Arctic Slope Regional Corporation. That's the largest native corporation in Alaska. And we're part of a consortia there, and that's looking at things like, excuse me, like direct air capture and carbon sequestration. So we're anxious to progress those. We have a bit of time between now and first oil to get those in place, and that's a promise that we'll deliver. So that concludes my slides, but to wrap up, I just leave you with that we've did a lot of pre-work to get to this point. The project's off to a really good start, and we look forward to being a significant cash contributor in 3.5 short years from now to the company. And as Kevin said at the start, I have my colleague Mark Ireland is here. We look forward to catching up and chatting on, during breaks or at dinner tonight with any questions you might have. And we'll be giving more updates as things progress. So with that, I guess we can take our break and then move on to the Ops Center tour. Thanks.